All right, well, bank earnings still providing a bit of a mixed picture as Goldman Sachs suffers a shortfall in its profit while Morgan Stanley pops on an earnings beat. Here to discuss the mixed environment for banking amid heightened macro uncertainty is Devin Ryan, JMP Securities Director of Financial Technology Research. Good to see you, Devin. So as we're seeing here, some mixed results. In your notes, you're saying not necessarily surprising, but what about Goldman Sachs? What should we read into that?
Morning, Rochelle. Great to see you. Thanks for having me on again. I think for Goldman, there's a few things. And it's actually a little bit less revenue centric. It's more, the compensation ratio is a little bit disappointing, particularly because they're still going to have to absorb those headcount reductions in 2023. I think that was a little disappointing to the market. Credit costs were a little bit higher than I think people were expecting. And then, the stock's also had a really nice move here. It's up, roughly 25%. From last quarter's earnings print. So, arguably got a little bit ahead of itself. And so that's why, heading into earnings season, we were a little bit more neutral on, the large cap investment banks, just given the moves we've seen. But, really for Goldman, I think we're going to put this quarter behind us pretty quickly. And the attention all turns to 2023, where it's going to be a tough start to the year, in our opinion. But we're actually probably more constructive than consensus as we look into the back half of the year.
In fact, you have a price target on Goldman Sachs of $470. What is going to get it there?
Yeah, so as I said, I think the near term, it maybe even got a little bit ahead of itself, and that was our view of why we were neutral into earnings. What needs to change is the capital markets backdrop. They're the most capital market centric of the large banks, and 2022 was an aberrationally challenging year. And I think the question is 2023 going to be better? And covering capital markets for 20 years or so, the one thing that we know is that uncertainty and big change in markets is never good. And so our view is that even if, the 2023 economic view is a little bit softer than 2022, which I think, a lot of banks are coalescing around right now, I think we're gonna have more certainty around that. And that'll actually be a better environment for things like investment banking, M&A. And so that's the environment where Goldman Sachs stock is going to do better. And then on top of that, I think they're going to give a lot more detail at their investor day in late February. And maybe even the stock starts to move positively into that, because I think that, they're very focused on operating margins. They're very focused on their return on equity targets. And I think they're going to pull a lot of levers to try to improve their financial position. So those are a few things, again, just kind of some near-term versus long-term dynamics today.
And as we look at some of the stronger performance here, JP Morgan beating consensus on fourth quarter earnings there. What is your take on what JP Morgan is perhaps doing right, or how it's managing the situation versus, say, a Goldman Sachs or the others?
Yeah, I think a little bit of it's just business mix. So, JP Morgan, not to take anything away, because they're really hitting on many cylinders across their business and taking market share, as is Goldman Sachs. But, there's been huge tailwinds for banks that are net interest income driven, which JP Morgan obviously is benefiting from higher rates and some loan growth. They're still executing on their plan. I think they're preparing for a mild recession. I would say if we get a mild recession, financial stocks actually do, I think, relatively well. The thing that we have to avoid is a deep and prolonged recession. Heading into this year, I think there's a lot of concern around a hard landing and a deep recession. As we're getting data that's maybe suggesting that it may be a little bit softer than that, that's why these stocks have started to perform better. And I actually think that we can see another leg into the back half after, what's still going to be, in our opinion, a pretty choppy quarter or two here. Just, the first, second quarter probably going to look pretty similar to how we ended last year, which was, obviously a tough end for particularly capital markets.
And Devin, we saw from Jamie Dimon, he raised the risk of a mild recession. We saw Bank of America, Wells Fargo echoing those sentiments as well. When you look at some of these large lenders who are bracing for recession, worried that perhaps some of these borrowers are going to start defaulting on those loans, who do you think is the best prepared at this point? Are enough banks prepared for what might happen?
Yeah, so I think the large banks are preparing, and they tend to be a little bit conservative and want to get ahead of issues. So the fact they're talking about a mild recession, I think, is actually good, because if things were really turning over, they'd probably be getting even more conservative than that. I think the areas that are softening the most are kind of obvious. Housing and banks, associated with that are, I think, going to be challenged. And banks kind of attached to the lower end consumer. Inflation, even as it's rolling over here, is still creating some headwinds for kind of the lower end of the consumer spectrum. And so, folks with exposures to those types of loans, the good news is most of the big banks that we look at in the investment banks, very diversified, And actually, if you look over the past year, yes, some businesses that are tied to higher rates were doing well. As we talked about capital markets and some other areas like asset and wealth management, with equity markets down 20%, we're seeing big headwinds. And so we actually expect more of a mean reversion in those areas, which will offset even some slowdown in a couple of those buckets that I just mentioned. So that's why having diversification and having scale, I think, is really important as we look out over the next year.
So, Devin, what are you going to be looking for in terms of the commentary that's coming out from these earnings reports?
Yeah, so I think what we're hearing and what we're paying attention to is credit. That's telling us about kind of the economic view. And thus far, credit's really hung in, I think, better than we probably would have expected 6 months ago, just given what's happening in the markets. I think we need to continue to hear that type of commentary moving forward, and there's still a lot of uncertainty. And so thus far, I think the credit commentary, obviously, big banks with large deposit bases. What are customers doing with that excess cash? Are they moving it to alternatives? Are they having to spend that and pay their bills? And so I think watching kind of the deposit evolution is another area. I would say thus far earnings season's been pretty much as expected, and I think that's a good thing. Again, the big question from here is the magnitude of the slowdown. Clearly, the economy is going to slow with much tighter financial conditions. The magnitude, if we can avoid a deep recession, I think financials, these banks actually do very well. But that's the type of commentary we're looking for. How much is this slowing economy affecting their businesses?
We'll certainly be keeping an eye on that as well. A big thank you there to Devin Ryan there, JMP Securities Director of Financial Technology Research, for joining me this morning. Thank you.